There's a saying in the intelligence community, the loudest threats are rarely the most dangerous. It is the quiet ones you need to fear. In financial markets, we are conditioned to look for noise. We look for the massive green candle that shoots to the moon. We look for the violent red crash that signals panic. We look for volatility. But right now, if you look at the silver chart in the low 60s range, you see something strange. You see nothing. The price drifts a few cents down, a few cents up, then freezes again. To the casual trader, it looks like boredom. It looks like the rally has stalled. It looks like confusion. But if you peel back the surface and look at the volume, the real heartbeat of the market, you see a battlefield. Billions of dollars in paper contracts have been hurled at silver over the last few sessions. Banks have shortened aggressively. Algorithms have dumped relentlessly. And yet the price refuses to break. It refuses to fall. It refuses to obey. Why? Because someone is standing there. Someone enormous. Someone with pockets deeper than the bullion banks. Someone who has planted a limit buy order so massive that it is absorbing the entire global supply of silver without blinking. We are witnessing the arrival of a mega whale, not a Reddit mob, not a hedge fund chasing a quick flip. A strategic buyer whose presence will alter the balance of power in this market forever. This is not speculation. This is not hype. This is forensic evidence. And in this investigation, we're going to hunt this whale. We're going to use volume signatures, order book behavior, and cross-market correlations to show that a historic transfer of ownership is underway. We are going to connect the dots between the exploding energy demands of artificial intelligence and the sudden disappearance of physical silver. And we are going to show why a flat price with massive volume is the single most bullish signal in existence. The market isn't quiet. It's loading. And you need to be on the same side as the entity doing the loading. To understand what's happening at $63, you must understand how smart money buys. If you or I want silver, we log into a brokerage app and hit Market Buy. The price ticks up a little. We get our shares. But if you want to buy $650 million on worth of silver, roughly 10 million ounces, you cannot hit the Market Buy. If you did, the price would detonate to $100 instantly. You would destroy your own entry. You would slip yourself into oblivion. So what do? You use an Iceberg Order. An Iceberg Order is an institutional weapon. It places a tiny visible order on the book, maybe 5 contracts. But hidden beneath it, in the dark pool, sits a monstrous order for 50,000 contracts. Every time a seller hits the visible 5, the algorithm instantly reloads them. Sell 5, reload 5. Sell 5, reload 5. The price doesn't move, it stays pinned at the whale's chosen level. But the volume meter spins like a turbine. Sellers think there is infinite demand at that price. They keep selling, they keep feeding the beast. Eventually they run out of ammo, and when the sellers are exhausted, the whale removes the wall, and the price gaps upward like a rocket. This is exactly what we are seeing at $63. Every time the banks try to smash the price, it hits an invisible concrete floor. It doesn't bounce, it stops dead. That stop is the whale's mouth opening. Based on the turnover in the last 48 hours, we estimate a single entity has absorbed 10 to 15 million ounces between $650 million and $1 billion in capital. Who has that kind of money? Not a hedge fund. Hedge funds fear commodities, not retail. Retail is exhausted, not a bullion bank. Banks sell into rallies, they don't defend floors. This footprint belongs to a strategic corporate entity, a company that needs silver not for speculation, but for survival. A company that sees $63 not as expensive, but as cheap insurance. We are watching the accumulation phase of the decade. And the longer the price stays flat, the bigger the explosion when the whale is full. What we re-witnessing in this consolidation zone is a handoff, a transfer of ownership from weak hands to strong hands. The weak hands are the speculators who bought at 50, hoping for a quick flip. They're nervous. They see the price stalling at 63. They fear a crash. Every dip triggers panic selling. They provide the liquidity. The strong hands are the buyers. They are not nervous. They have a 10-year horizon. They buy every moment of fear. This process, where volatile traders exit and long-term holders enter, is the foundation of a supercycle. It is the concrete poured beneath a skyscraper. The 63rd level is becoming concrete. The fact that silver is not collapsing after a vertical rally proves the market has changed character. In 2011 or 2020, a vertical rally was always followed by a crash because it was driven by paper hype. When the hype died, the price died. Today, the hype is dead, but the price is holding. That is the tell. Demand is no longer optional. Someone must buy. The casual observer sees a flat chart and thinks silver is dead. The professional sees a flat chart with massive volume and knows silver is being cornered. The free float is being sucked into a black hole. Once the weak hands are gone, once the last nervous trader sells his position to the whale, there will be no one left to sell. And that is when the price enters true price discovery. But before we go deeper, we must answer the question everyone asks. Isn't this just the banks covering their shorts? It's a fair question, but the data says no, and that is where the next part begins. The question everyone asks is the same. Isn't this just the banks covering their shorts? Isn't this JP Morgan quietly unwinding a position? Isn't this the same old game we've seen for decades? It's a fair question, but the data doesn't lie. And the deeper you look, the clearer it becomes. This is not bank behavior. This is not desperation. This is not a panicked unwind. This is something far more controlled, far more deliberate, far more strategic. Start with the timing. Bank short covering has a signature. It happens during the London fix. It happens at the close. It happens in violent bursts. Sloppy, emotional, chaotic. Banks cover when they're cornered, and when they cover, the chart looks like a heart attack. But the buying we're seeing now is calm, it's steady, it's algorithmic. It happens in Asia, it happens in Europe. It happens in the US pre-market. It never stops, it never spikes, it never panics. It just absorbs. That is not a bank trying to escape a burning building. That is a machine executing a plan. Then look at the physical market. If this were just paper short covering, the spread between paper silver and physical silver would narrow. But the opposite is happening. Physical premiums in Shanghai are rising. Wholesale premiums in the US are rising. The gap between paper and physical is widening even as the paper price stays flat. That means someone is taking delivery. Someone is stripping metal out of the system. Banks don't do that. Banks roll paper. They don't drain vaults. And then there's correlation. Look at what else is moving. Copper is bidding. Uranium is bidding. AI tech stocks are bidding. Silver is no longer trading like a monetary metal. It's trading like an electrification metal. It's decoupling from gold and coupling with the industrial basket. That tells us the buyer is not a currency speculator. The buyer is an industrial entity. Someone who needs silver the way a factory needs steel. Someone who is securing a supply chain, not making a bet. So, if it's not a bank, and it's not retail, and it's not a hedge fund, who has $30 billion in cash, needs massive amounts of energy, and is terrified of a supply shortage. Big tech. The AI hyperscalers, Microsoft, Google, Amazon, Meta. The companies building the digital brain of the 21st century, and discovering that the brain requires a body. AI doesn't run on magic. It runs on electricity. And electricity runs on infrastructure. And infrastructure runs on metals. And the most important metal in the electrification chain, the metal that sits at the center of solar, batteries, power grids, and high-efficiency electronics, is silver. This is the connection Wall Street refuses to talk about. This is the link that ties the AI revolution to the sudden disappearance of physical silver. This is the reason a mega whale is sitting at $63, absorbing everything in sight. Because AI is hitting a wall made of energy, a wall made of physics, a wall made of silver. To understand why, you need to understand the energy footprint of artificial intelligence. A standard Google search uses 0.3 watt-hours of electricity. A ChatGPT query uses 3 to 10 watt-hours. That's a 10 to 30-fold increase in energy per click. And as the models grow, as we move toward GPT-5, GPT-6, and eventually AGI, the energy consumption doesn't rise linearly. It rises exponentially. The grid cannot handle it. The US grid is old. It is fragile. It is already strained. And the tech giants know this. They know they cannot rely on public infrastructure. They know they cannot wait for governments to modernize the grid. They know they must build their own power systems, their own solar farms, their own battery banks, their own microgrids. And that requires silver. Not a little silver, a mountain of silver. This is why the whale is here. This is why the price is pinned. This is why the volume is exploding while the chart looks dead. The whale is not speculating. The whale is not trading. The whale is not playing games. The whale is securing the raw material required to power the next decade of AI. And the most important clue of all, but the smoking gun, is the partnership that changed everything. The $30 billion AI infrastructure fund launched by BlackRock and Microsoft. Hidden in the fine print is the phrase that explains the entire silver market: to build data centers and the energy infrastructure to power them. Energy infrastructure, not servers, not chips, energy, solar fields, battery banks, transmission lines, microgrids, all of them require silver, and the fund is larger than the entire annual global silver mining industry. This is why the whale is buying. This is why the price is flat. This is why the volume is insane. This is why the float is disappearing. The whale is not betting on silver. The whale is buying electricity in solid form. And the deeper you go, the more the picture sharpens. The tech giants have all made public commitments to be carbon negative or net zero by 2030. They cannot build coal plants. They cannot build natural gas plants. Nuclear takes a decade. Wind is unreliable. That leaves one option: solar. Not rooftop solar, not hobby solar. Gigawatt-scale solar farms covering entire counties. High-efficiency solar panels require silver, So do the batteries that store the energy, so do the inverters that convert it, so do the transmission lines that carry it. Silver is the bloodstream of the AI energy ecosystem. And the tech giants have realized something terrifying. The silver market is too small to accommodate them, so they are front-running the shortage. They are buying the mine before they build the factory. They are securing the metal before they build the grid. They are cornering the supply before the world wakes up. This is why the Iceberg Order exists. This is why the price is pinned. This is why the volume is exploding. This is why the float is vanishing. The banks are fighting the past. The whale is buying the future. And now that we know who the whale is and why they're here, the next question is simple. What happens to everyone else? That's where part 3 begins. Now that we know who the whale is and why they're here, the next question is the one nobody wants to ask out loud. What happens to everyone else? The silver market is not infinite. It is not elastic. It is not a bottomless pit of supply. It is a zero-sum game. Every ounce that goes to one buyer is an ounce that cannot go to another. And when a giant enters the room and starts inhaling the oxygen, the smaller creatures suffocate. Silver production is roughly 830 million ounces a year. That's it. That's the entire global supply. If Microsoft, Amazon, Google, and Samsung suddenly demand an extra 200 million ounces, that metal has to come from somewhere. It has to be taken away from someone else. Economists call this crowding out. In the real world, it looks like panic. Start with medicine. People forget that silver is the most antimicrobial element on the periodic table. It's in burn creams, it's in catheters, it's in surgical tools, it's in hospital filtration systems, it's in wound dressings. Silver is not optional in medicine. It is essential. A hospital cannot say, silver is too expensive, let's use plastic. People die. Then look at the military. A Tomahawk cruise missile contains roughly 500 ounces of silver. Torpedoes use silver zinc batteries. Fighter jet cockpits use silver-coated glass. Guidance systems use silver because nothing conducts electricity better. In a $1 million weapon, you don't use copper, you use the best. The medical sector and the military-industrial complex are price inelastic. They do not care what silver costs. They must have it. So what happens when the tech whale absorbs the inventory at $63? The Defense Logistics Agency wakes up, hospital procurement networks wake up, they call the refiners. And the refiners say, sorry, Samsung bought it all. This triggers a bidding war, not between speculators, but between national security and public health. The U.S. military has legal priority. They can invoke the Defense Production Act. They can seize the supply before it reaches Apple. But Apple has the cash. Apple has the contracts. Apple has the lawyers. This clash creates a vacuum upward. If the military seizes the supply, Apple must bid higher for the remaining scraps. If Apple secures the supply, the military must pay a premium to divert it. This is the collateral damage. The tech whale didn't intend to start a crisis in medicine or defense, but by hoarding the float, they have squeezed the most sensitive industries in the world. As an investor, you need to understand this. You're not holding a speculative asset. You're holding the metal that Raytheon, Pfizer, and Microsoft are fighting over. That is not a risky position. That is a fortress. So who loses? If tech, military, and medicine must have silver, who gets pushed aside? Jewelry, silverware, decorative silver. India consumes a massive amount of silver for cultural reasons. Anklets, bracelets, plates, and ornaments. But there is a price point where culture gives way to cash. When silver hits $50, $60, or $70, Indian demand flips from buying to selling. A housewife in Mumbai looks at her silver plates and sees a down payment on a home. She sells. The refiner melts it. That silver goes to Samsung. This is the scrap cycle, the only relief valve the market has. The whale at 63 is counting on it. They are counting on high prices to flush out old silver from the jewelry market so they can consume it in the industrial market. But here's the catch. Scrap supply is finite and slow. It takes time to convince 1 billion people to sell their heirlooms. It takes time to collect it, melt it, and refine it to 999 purity. The tech whale needs silver now. The scrap cycle takes years. This mismatch, immediate industrial hunger versus slow scrap response, is what causes price overshoots. We are about to witness the destruction of the decorative silver market. Silver is becoming too valuable to wear, too valuable to eat off. It is returning to its true purpose, strategic industry. If you own silver jewelry, keep it. It may be the last generation that can afford it. Now let's talk about you. How do you play this? You're not a whale. You cannot move the market. If you try to fight the whale, you get crushed. If you try to front run the whale, you get shaken out by volatility. The strategy is to draft. In racing, drafting means riding in the slipstream of a larger vehicle. They cut the wind resistance for you. You use less energy to go faster. The Iceberg Order at 63 is your semi-truck. The whale is spending billions to defend this level. They're absorbing the selling pressure. They're building the floor. Your strategy is simple. First, don't get bored. The whale wants you bored. They want the price flat, so you lose interest and sell to them. Boredom is the trap. Second, buy the base. Every time the price touches the bottom of this consolidation range, you buy. You're buying with the whale. You put your stop loss just below their iceberg. If the whale leaves, you leave. But as long as they're there, you're safe. Third, watch the volume. As long as volume is high and price is flat, accumulation is happening. And when volume drops, the whale is full. That's when the price explodes. If you're buying physical, where do you put it? The whale isn't using COMEX. They aren't using bank safety deposit boxes. They're using private, non-bank vaults. You should do the same, or hold it yourself. Drafting is simple. Identify the big buyer, do what they do, wait for them to push the price up. Right now, the big buyer is accumulating at 63. They are telling you with their wallet that 63 is a bargain. Who are you to argue with $30 billion? But an iceberg order cannot last forever. Eventually the sellers run out. Eventually the whale fills their bag. Eventually the limit buy disappears. And when that happens, when the artificial floor is removed, the price doesn't tick up. It teleports. When an iceberg order finally disappears, the market doesn't whisper. It detonates. And that's exactly where we are now. The whale has been sitting at $63, absorbing everything the world could throw at it. Billions in paper shorts, waves of algorithmic selling, nervous retail dumping their positions. And through all of it, the price refused to break. That wasn't luck. That wasn't a coincidence. That was a wall. A wall built by a buyer who needed metal, not charts. But whales don't eat forever. They eventually get full. And when they do, they stop defending the floor. They pull the order, they step back. And in that exact moment, the market enters the most violent phase of any bull cycle, the markup phase. The phase where price doesn't climb, it leaps. The phase where resistance evaporates. The phase where the chart stops behaving like a market and starts behaving like a vacuum. To understand what happens next, you need to look at the volume profile of silver. This tool shows where the market has memory, where traders bought, where they sold, where they got trapped. In the 20s, silver built a massive base, years of accumulation. Then it built another base in the low 60s, the one we're sitting on now. But look above 65. Look at the chart history from 1980 to 2011. Price spent almost no time in the 70s or 80s. It shot up through them instantly. It crashed down through them instantly. There is no volume there, no memory, no bag holders waiting to sell, no overhead supply. That empty space is an air pocket, a vacuum. And in a vacuum, physics changes. A small amount of buying force creates a massive amount of price movement. If the whale buys 1 million ounces at 63, the price moves 10 cents. If the whale buys 1 million ounces at 68, the price might move $5. Why? Because there are no sellers. The sellers were cleaned out at 63. The only people left holding are the diamond hands who want triple digits. This is why the markup phase is so violent. You will wake up one morning and silver will be up $4. You will go to lunch and it will be up another $3. The media will scream bubble, they always do. But it isn't a bubble. Its price is moving through a vacuum to find the next area of liquidity. And according to the historical volume profile, the next major liquidity zone, the next place where sellers might appear, is the inflation-adjusted high of 1980. That level is well above $100. But before we get there, there's one final trap. The banks know about the vacuum. They know that if 65 breaks, they die. So before the whale lets the price run, we often see one last dirty move, the stop run. Just before the breakout, the price might dip sharply one last time. It might drop from 63 to 61 in 5 minutes. Why? To trigger trailing stop losses, to shake out the last weak hands, to flush out anyone who bought the base but doesn't have the stomach for the markup, to verify that there are no more sellers left. This is the springboard. If you see a sudden inexplicable drop in the next 24 hours, do not panic. Look at the volume. If the price drops on low volume, it's a trick, a head fake. The whale is testing the perimeter. They're checking the fence for holes before they release the bull. If you sell into that dip, you're handing your ticket to the conductor right before the train leaves. Stay calm. The structure is bullish. The accumulation is real. The volatility is just the engine revving. But now we need to talk about something harder than buying the bottom, holding the winner. When silver hits 70, you're going to feel like a genius. You're going to see massive profits. And your brain, your ancient survival-wired brain, will scream, sell, take the profit, it might go down. This is the most dangerous instinct you have, because you're thinking in fiat terms. You're thinking, I made $10,000. But what are those dollars? A currency is being diluted, a currency losing purchasing power, a currency that buys less every year. If you sell your silver at 70, what do you get? Dollars. What will you do with those dollars? Buy stocks, overvalued, buy bonds, negative real yield, keep it in the bank. Inflation eats it alive. The hardest part of a bull market is not buying early. It's holding long enough to capture the real move. And the real move hasn't even started. Because once the whale steps away, once the 65 wall breaks, once the vacuum opens, the market enters a phase where price discovery becomes violent. The banks will try to fight it. They will throw paper at the market. They will trigger stops. They will attempt to engineer fear. But they are fighting physics. They are fighting scarcity. They are fighting the largest buyers on earth. And the tech giants are not buying silver to trade it. They are buying it to consume it, to melt it, to paste it onto solar cells, to solder it into circuits, to bury it inside batteries. Once that silver is used, it is gone. It does not return to the market. It does not get recycled. It becomes part of the infrastructure of the AI age. This is the difference between a speculative bull market and a structural bull market. In a speculative bull market, price rises because traders believe they will rise. In a structural bull market, price rises because the metal is disappearing, because the float is shrinking, because the industrial world is swallowing the supply. We are in a structural bull market. The whale is not betting on silver. The whale is building the future. And the moment they stop accumulating, the moment they remove the floor, the moment they let the price run, the market will realize something terrifying. There is no silver left for anyone else. That's where the final chapter begins. The breakout, the targets, and the psychological armor you need to survive the vertical phase. We've reached the final stretch of this investigation. We've identified the whale, we've identified the motive, we've identified the victims. And now standing at the edge of the moment, the entire structure has been building toward the breakout. The point where the accumulation phase ends and the markup phase begins. The point where the quiet becomes violent. The point where the market stops pretending and starts revealing the truth. The price of silver has been pinned at $63 for a reason. It wasn't stuck. It was held. The whale placed a massive iceberg order to absorb every ounce of liquidity the market had to offer. They weren't trying to move the price. They were trying to build a fortress. They were trying to drain the float. They were trying to secure the metal before the world realized what was happening. But whales don't defend floors forever. They defend them until they're done. And when they're done, they step aside. And when they step aside, the market doesn't walk upward. It sprints, it leaps, it teleports. This is the moment we're approaching. To understand what happens next, you need to understand the structure of the chart. Silver has built two massive bases of volume, one in the 20s, one in the low 60s. These are the foundations. These are the zones where the market spent time, built memory, created bag holders, created support. But above 65, there's nothing. No memory, no resistance, no supply. The price history from 1980 to 2011 shows the same pattern. Silver shot through the 70s and 80s like a bullet. It didn't pause. It didn't consolidate. It didn't negotiate. It just moved. That empty space is a vacuum. And in a vacuum, price behaves differently. A small amount of buying force creates a massive amount of movement. The banks know this. The funds know this. The whale knows this. Everyone who understands the structure knows that once 65 breaks, the market enters a zone where the price is free to run until it finds the next pocket of liquidity. And that pocket is far above $100. But before the breakout, there's always one final test, the stop run. The banks will try to shake out the last weak hands. They will try to trigger trailing stops. They will try to create fear. They will try to engineer a dip that looks catastrophic, but is actually meaningless. You might see silver drop from 63 to 61 in minutes. You might see a sudden red candle that looks like the end of the rally. But if the volume is low, it's a trick. A head fake, a final attempt to flush out anyone who doesn't belong in the markup phase. If you sell into that dip, you're handing your seat to someone who understands the game better than you. You're giving up your position right before the move you've been waiting for. The whale is not scared of that dip. The whale is creating it. They're checking the perimeter. They're making sure there are no more sellers left. They're preparing the runway. And once the runway is clear, the rocket ignites. But here's the part most people are not ready for. The hardest thing in a bull market is not buying the bottom. It's holding the winner. When silver hits 70, you'll feel brilliant. When it hits 75, you'll feel invincible. And that's when your brain will betray you. It will whisper the same thing it whispers to every trader who has ever lived. Take the profit. Don't be greedy. It might fall. That instinct is ancient. It's survival. It's fear disguised as wisdom. But it's also the reason most people never capture the real move. They sell too early. They sell because they're measuring their wealth in dollars. They're thinking, I made $10,000. But what are those dollars? A currency is being diluted. A currency losing purchasing power. A currency that buys less every year. If you sell your silver at 70, what do you get? Dollars. What will you do with those dollars? Buy stocks? Overvalued. Buy bonds? Negative real yield. Keep it in the bank? Inflation eats it alive. The real question is not, how much profit did I make? The real question is, what am I exchanging my silver for? And if the answer is a melting currency, then you're not taking profit. You're taking a loss in slow motion. This is why the whale doesn't care about the price. To Microsoft, to Amazon, to Google, to Meta, silver at $100 is a rounding error. They're not buying silver to trade it. They're buying it to consume it, to melt it, to paste it onto solar cells, to solder it into circuits, to bury it inside batteries. Once that silver is used, it's gone. It doesn't come back. It becomes part of the infrastructure of the AI age. This is the difference between a speculative bull market and a structural bull market. In a speculative bull market, price rises because traders believe they will rise. In a structural bull market, price rises because the metal is disappearing, because the float is shrinking, because the industrial world is swallowing the supply. We are in a structural bull market. And the whale is not betting on silver. The whale is building the future. The moment they stop accumulating, the moment they remove the floor, the moment they let the price run, the market will realize something terrifying. There's no silver left for anyone else. The medical sector will panic. The military will panic. The jewelry market will collapse. The refiners will scramble. The banks will choke. And the price will move through the vacuum like a bullet. This is the moment where the quiet becomes loud, where the flat line becomes a vertical line, where the boredom becomes chaos, where the accumulation becomes the explosion. The Iceberg Order was the warning. The breakout will be the confirmation. And when it happens, you will not have time to think. You will only have time to hold. Because the markup phase is not a gentle climb. It is a sprint. It is a squeeze. It is a reckoning. And it is coming.